What makes Boroden think that we're due for a tradable low? The same things that warned her the market could peak in early September. Take a look at this next daily chart of the S&P 500, all right? First, we see a cluster of 7 Fibonacci timing cycles coming due between today and Thursday. You can see that, right? That's the main reason she's so confident we can see the counter trend rally here, like we had today. But more so, it could be continued to be good. Again, though, she's only looking for a temporary counter trend rally and not an actual bottom, and even that isn't guaranteed. Just because we got a bunch of Fibonacci timing cycles coming due at the same time doesn't necessarily mean the S&P will make a low and reverse course. These timing cycles merely tell her that the odds of reversal are higher during these few days. If you want to pull the trigger, Boroden still recommends patiently waiting for a solid buy signal on top of these timing factors. Now, there's another reason she expects the rebound here to continue, at least for the moment. Take a look at this weekly chart of the S&P. When you look at the decline from the September highs, the recent decline is only similar to previous corrections within a larger uptrend. Boroden believes this market can find a nice floor of support around 4205, 4278, and sure enough, 4278 is the level the S&P bounced off during yesterday's meltdown. That appears to be the floor, 4278, at least for now. Keep that number in mind. However, once again, Boroden won't be putting a ton of faith into this rebound until we get a buy signal. For her, that's when the 5-day exponential moving average, which we can't see right here, crosses back over the 13-day exponential, and that just hasn't happened yet. And it would take a few more days of upside to even get close. Remember when I showed you the sure like sign of death? Well, this would be a sign of life. Until we get Broden's favorite moving average crossover, she can only see this rebound as a bit of a relief rally. That said, even if we can't shake the broader decline, she's convinced that we're due for a bounce, and today may be just the beginning of that bounce. I think she's making a compelling point. Remember, the market got very oversold yesterday, and when stocks come down too far, too fast, we tend to get more constructive here on Mad Money. That's what I told you last night. Also repeated that in my investment club note, because I think this is very important to keep club members up. Now, it doesn't mean the pain is over, but it does mean you need to be prepared to do some buying in your favorite names, especially if they kept coming down, which is what we did for the charitable trust. Also, don't forget, this whole late September swoon was predicted by the legendary Larry Williams based on the history of the action over the last 23 years. If history is any guide, this weakness tends to extend into October. But then the market typically starts to rebound, so we could soon escape from the seasonally difficult period. By the way, the last 2 weeks of October have historically been terrific. Here's the bottom line. The charts, as interpreted by Carolyn Boroden, suggest that today's bounce might not be the end of the relief rally because we were due for reversal, even if it's a temporary one.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.